This week, we see a slew of economic data showing us that economies are rolling over. And worse still, we have sentiment indicators at all-time lows, at least in recent memories. The point is that corporate earnings for 2023 have not seen major downgrades yet. So to talk about this and other things that have been going on this week, I am joined by CIO of Textron, Charles Van Vleet. That is this week's big conversation. Charles, welcome to the show.
Thanks for having me.
Now, this is the big conversation. So in this show, we do ask what are the biggest issues of the week. So just from your point of view, what do you see as the biggest issues in markets right now?
No surprise. It's about the Fed and response to inflation and implications not only to monetary tightening, but how the market reaction to that.
And if you were to give like a time duration, I know it's almost an impossible question to ask, but this dislocation that's going on right now, how long is it going to be until the market starts to find its feet, whether it's the credit market or the equity market?
I think we're done with the rate correction. I don't think we're quite done with the spread correction. So remember, there's rates and then there's credit spreads on top. And the equity correction has more to go.
Okay, so let's stick with equities for a second, because I do want to ask you about the other asset classes. In equities, as we alluded to in the introduction, we have seen economic indicators, Kansas, Dallas, there's been the Fed manufacturing rollovers over the past week that came out last Thursday. We've seen those numbers rolling over quite heavily. Yet for 2023, we're still not seeing material corporate downgrades yet. Now, does that mean that equities still have further to go lower? Because consumer sentiment is at low in recent memory. So what do you think?
Yeah. Now you make a good point that so far the correction we've seen was simply a result of the discount rate. So remember, equity valuations, you look out at 20 years worth of forecast earnings on selling those Apple phones, and then you do a net present value of those cash flows. That net present value, you need something called a discount rate. The discount rate, you reference U.S. Treasury rates. Treasury rates are higher. Your discount rate is higher. So your net present value is lower. That's what's driven the stock market correction so far. We've done nothing yet on actual earnings revisions, much to your point. So that's the next shoe to fall, or maybe that's too aggressive a word. It's the next bit of correction. It's not. This is not an 08 correction. This is not an 01 correction. It's a 94 correction. It's not. This is not a death knell.
Okay. So, I mean, is the best thing to do wait to see these downgrades come through, filter through these stock prices, and then look at what you like or what you don't like? Or do you think there are certain sectors now which are just being dragged down by equity markets more broadly, and now's a good time to buy?
Yeah, I'm not a big market timer in terms of what's in and out. I would rather be picking my spots. I think you said that well. So, markets like this, what you want is products or services which have pricing power. Things which, good times are bad, you're going to buy. I have an old saying about drinking, right? I drink in good times and drink in bad times. Which is exactly why alcohol stocks is a great place to invest in both good times and bad times.
Is that one of your biggest area of holdings?
I teasingly tell my team that we should be investing a lot in cat stocks. And they say, cat stock? Chocolate, alcohol, tobacco. Why?
Oh, right.
I consume all three and I will pay any price they want for it. So those are called consumer staples which have perfect pricing power. Mm-hmm. So in good times or bad, people are going to buy chocolate, alcohol, tobacco, and you can add to that iPhones, you can add to that maybe your Google search engine. So things which have pricing power. So rise in rates, the company is able to pass it through to the consumer's glad to pay it. So so rather than time your market, I'm in or I'm out or what's the right timing, just be thoughtful about what sectors, where's their pricing power, what kind of products or services.
And is balance sheet a very important thing to be looking at right now for these companies? I mean, we'll come on to credit in a second, but those companies that are inverted commas, growth companies, is it just going to take them a lot longer to come back?
Well, the danger for companies with a poor or a weak balance sheet is they're dependent upon that ability to borrow. The credit market's still open so far. They're able to borrow a bit more expensive, but nothing. Balance sheets for both the household as well, there's over and over again, for the balance as well as for business, in fine shape so far. So the way to measure it is things called the debt coverage ratio. So you take how much cash do I have or generate each year as a multiple of my debt service capacity, my debt service obligation. So right now we're running about 2.5%, 2.5 times. So I generate enough or have enough cash to make 2.5 times of my annual debt service. That's a very healthy number. That's both at a household as well as a corporate balance sheet. So credit spreads, not a problem, but in great shape overall.
So, Charles, at what point do you think, you alluded to earlier about the Fed, at what point do equity markets have an effect on the Fed's decision to keep hiking or to change that?
Well, I think that's, no doubt they're keeping track of this and monitoring. So, the real heavy lifting is being done by the markets. We've wiped out $5 trillion worth of equity market purchasing power. We've knocked out another $2 trillion worth of crypto purchasing power. I mean, that's $7 trillion worth of purchasing power that would have gone to, buying an airplane ticket or buying a new phone or to go on a trip to the West Coast or to buy private airplanes like my company makes. So that's $7 trillion less. So the Fed's just kind of sitting back saying, thank you, market, for doing my lift for me. So it's not only the market stock and crypto market, but the dollar is running, unbelievably strong levels. Terrific time to be in London this week, by the way, at exchange rate 122. And but that means that helps to lower U.S. inflation as well, and helps to again kind of dampen S&P earnings, because 40% of the earnings come from abroad. So the Fed is sitting back saying, "Thank you, market."
Yeah,
they're not going to reach in and save it this time, but they're saying the market's doing the lift.
Charles, it's something I've heard you say before, and I'd love you to repeat it again. It's something my parents actually say to me all the time. There's all these fiscal stimulus packages, and everyone, my parents always ask me, well, who's going to pay for this in the future? Well, you think, well, there's higher taxes, but you gave a lovely answer last time about, inflation is itself a tax, and I wanted you to just repeat that again.
Yeah, I guess I had shared with you, it goes back to my econ degree at UC Berkeley in 1977, and they said, yes, inflation is a tax, and there's two kinds of taxes. One, you write a check to the IRS, and the other is a tax called inflation. And the first one is a very progressive tax, one that the write the check has, progressively higher for higher incomes. And the latter one, inflation, is a very regressive tax. It tends to hurt people with the small amount of disposable dollars, the least amount of disposable dollars. Well, we chose to pay for the fiscal expansion, which began under Trump and ended under Biden. And absolutely the right thing for Trump to do, absolutely to response to the emergency, but we chose to spend for our PPP program in March of 20, and then continued on end of 20, and again in 22, or 21 rather. We paid for that not with the first kind of tax, we're paying for it with the second kind of tax. So it's either you pay now or you pay later. With inflation, well, we're paying later, that's all. It's not the first time we've done this. Remember, it's all the wealthy 1%ers who are casting the vote about, do we pay with the first kind or the second kind? Maybe no mistake, we're paying with the second kind of tax.
And as you look out into the future, like if you were to try and predict how inflation is going to play out, what are you thinking into 2023?
I still think, Powell wasn't wrong when he said, remember, it was in February this year when he said this is primarily, a lot of it's transitory. And I think he was very correct at that time. And then we ran into March and with the attack in the Ukraine, which changed that dynamics. But Powell wasn't wrong or stupid. It was much more transitory prior to the invasion. With the invasion now, we had a one-time bump in oil. I think we're done with the oil. Oil's not going to 200. Oil's done, in this ballpark. But we've taken out 30% of the stock for row crops, and that's a permanent takeout. Well, I say a good 5-year to 7-year, because we've destroyed that row crop ability in the Ukraine, the breadbasket for certain crops. But the oil thing, Jamie, this idea that oil's going to go to 200 and we're going to stop Russian oil. You're not going to stop Russian oil. Russian oil is too valuable. It will get out of Russia if it has to be carried by yak over the Urals. Russia simply made a mistake of building the pipeline to the west when they should have built it to the east. That's just a matter of time. So Russia will sell their oil to China. They'll sell it to India, which means they buy it less from Saudi Arabia. Saudi Arabia will sell, that oil then in turn to Germany. The oil is fungible. Once that Russian oil is in the pipe, it is indistinguishable from any other oil.
Right.
The G7's meeting today to talk about how do they put it? A tax or a different tier, what they're willing to pay for Russian oil. Well, that's ridiculous. Because once oil is oil, it all looks the same once it's in the pipe. It's the whole point. So the Russian oil hasn't disappeared. We just need to redirect the pipelines a little bit. So, and right now we're paying $9 per unit for LNG here in the U.S. Germany's paying $36 for LNG. The only reason why that spread is because we don't have the pipelines. We don't have the ability to, as you know, liquefy it and get it on a train. We're building that capacity, and we will get to that capacity. So LNG will eventually resolve someplace between $9 and $36. There is only one LNG price once you have taken into account those pipelines that need to be built. Those pipelines are in the process of being built. So I think we're largely done with the energy impact.
Okay, so oil's done for now.
Yes.
So let me just change tack a little bit. For those people watching who are looking across their portfolio and trying to navigate these markets as you do so well, how about the credit portion of your portfolio? How are you thinking about that? What levels in the tier are you looking at investing in?
So I don't invest a lot personally, but in the pension that I invest in, I love first lien loans. And so particularly levered first lien loans. And there's two ways to get levered first lien loans. One is called the BDC, Business Development Corp. Those are US, those are listed funds, which are 2 to 3 times, but generally 2 to 2.5% times levered first lien loans. They trade daily liquid on the exchange. They have a yield of about 8.5 to 9%. They have a total return expectation, I'd say about 11. The second is a little more difficult to access in your personal account. In an institutional account, it's called CLO equities. So these are collateralized loan obligations. You buy the equity tranche, which is providing the support for the debt tranches above it. That equity tranche acts like a 10-time levered first lien loan. Again, difficult to access. Personally, for qualified buyers and private vehicles, it's available. It's a first lien loan where these are double B and single B credits, but first lien on the company in the event of default. Defaults right now running less than 1. Expectations could go as high as 3. You're not going to lose money until it goes as high as 6 or 7, which has never happened before. So I love the single B and double B areas of the market.
As we sit here in June 2022, and for people watching at home, what areas of the investment world do you find exciting, if any?
Well, I still think the equity market's infinitely exciting. These biotech stock, these growth companies are still phenomenal opportunities. What's going on with what's going on in life science and bioscience, what's going on with CRISPR, what's going on with the memory RNA. I mean, the breakthrough that you have to come through there. So how about the big one? What's going on with nuclear fusion right here in England? It's out of Cambridge, I believe, is where the best work is being done in nuclear fusion. Can you imagine, in 10 to 20 years' time, when that becomes our best energy source, it gets commercialized in 20 years' time, who needs oil? Who needs gas? In fact, once you get into nuclear fusion, I'll give you all the fresh water you want. The last time I looked, the Earth is 3/4 water, just has a bit of salt in it. So we get rid of the salt. I'll give you all the fresh water you want. So it solves so many problems, including a lot of military fighting over oil.
Well, Charles, I feel like I keep talking to you forever. There's so many nuggets of information there. I just want to say thank you so much for coming and seeing us on the show.
Good luck with the show.
Thank you.
Thank you.